Hi, this video looks at the income statement. I'm basically just going to be introducing the income statement and tell you why it's important for assessing business performance, and then we'll go on and have a look at how we can make judgments on the performance of the business through the information in an income statement. So what is an income statement? Well, it's a formal financial document that shows the value of a business's revenues over 1 year and the costs involved in generating that income. Okay, so this is basically a document that is really very, very important because it shows whether the business has made a profit or a loss. They were previously known as profit and loss accounts, but they're now called income statements, and it's used to find out how much money a business earned during the year. It shows the revenues that were generated and the costs that were incurred as a result. And obviously, if you take the costs from the revenue, you get the profit that the business makes. So they're used for a number of purposes. Number one, to see if the business's revenue have exceeded the costs. So in other words, has the business made a profit or not? They can be used to judge performance against the expectations, the targets, etc. They can be used to compare performance between companies or from year to year. So I'll show you an example of a income statement that goes from year to year. So in other words, looking at how that company performed in 2017 to how it performed in 2018. Or obviously you can look between rival companies. You can compare two different income statements. Potential shareholders might look at profit and loss accounts to see if the business is a good investment. Existing shareholders might look at it to see if they could potentially earn more money elsewhere, to make sure that their money is safe and invested in a good company. And banks might use an income statement to assess a company's ability to repay loans. So if I'm an existing business and I'm going for a bank loan, they'll probably want to see the last 3 years sets of figures so that they can see what the trends are and what's going on in the company. Here's an example of an income statement. Okay, it's laid out. We normally read left to right, but this isn't an accident. You can see that 2017 is on the right. The most recent year is on the left. I don't know why that is, but that's how they are laid out. We start off with the sales revenue. That's how much money was made, or total revenue. It means the same thing. We then take off the variable costs, although confusingly they're called cost of sales in these documents. And when you subtract the variable cost, or the cost of sales, from the sales revenue, that gives you your gross profit. So you can see here in 2017 they made 18,000 in revenue. Their variable cost was 9,000, so the gross profit was 9,000. Overheads or fixed costs come next, and we need to subtract them to get our final net profit figure. And yeah, that's it basically on the income statement. Okay, the key things that you need to know is that gross profit isn't the final profit measure. It's just minus variable costs. Net profit, sometimes called operating profit, is the other key formula that you need to know. Okay.